The 2008 global financial crisis was a big deal. And today we're going to talk a little bit about what happened exactly, why did this happen, and who was involved. And most of all, what was the role of different accounting institutions during this crisis, and how does this all relate back to accounting? And to do this, we have to talk about what a mortgage is. So usually individuals will go searching for a home to purchase, and once they found one that they liked, they need to find a way to purchase it because nobody has $500,000 just laying around at home. So the way they do this is by going to the bank. So the banks will first check whether the individual or individuals has the ability to pay off the mortgage debt and pay for this house. So the individuals will borrow hundreds of thousands of dollars from the bank, but in turn, the bank says, okay, we'll give you the money, but we want something else in return, something called interest. So the bank provides these new homeowners with large sums of money to purchase the house, and in return, the lender or the bank gets a piece of paper called a mortgage. So every month, these new homeowners must pay back the debt by repaying monthly payments portions of the principal plus added interest. In this case, it is the bank that is holding the piece of paper and gets paid. Now, this was the case with a normal mortgage payment. Even modern-day mortgages are structured the same way. However, things changed in the 1990s and the 2000s. So in a normal mortgage payment, home buyers sold their mortgages to lenders or banks. In the 2000s, lenders sold these investments to investment banks, and investment banks then created CDOs. CDOs were a complex and risky combination of thousands of different types of debts and loans to create and use mortgages as an investment instrument. Investment banks then sold these CDOs to investors because there was high faith in the US housing market, and investors saw these CDOs as low risk and high return. Now, mortgage payments from homeowners were going to investors instead of banks. Investment banks then paid credit rating agencies to evaluate these investments, CDOs, based on their risk. Most of these CDOs were rated AAA, which is the highest possible rating and the safest investment possible. However, most of these CDOs actually weren't AAA. They were actually much riskier than that. These risky investments were just a ticking time bomb. This is because banks started allowing individuals with poor credit ratings and non-paying jobs to obtain mortgages and pay very low interest. So when interest rates went up, people with these mortgages would not be able to pay off their debt. Good credit and ability to repay their mortgages as qualifications to get a mortgage went right out the door. And banks didn't care because the more CDOs they sold, the more money they made. And the more investments that credit agencies rated AAA, the more money they made. To make everything worse, financial institutions also sold other risky investments called credit default swaps. These swaps were basically insurance against CDOs in case people defaulted on their loans. They sold tens of thousands of these credit default swaps without actual money to back them up. These irrational decisions and rapid price increases created a bubble on housing prices, and this bubble bursted as soon as homeowners were unable to pay for their expensive properties. Ultimately, demand went really low and supply went really high as there were no new buyers. This resulted in a major decrease in the prices of houses. All these bets and all these investment instruments created this huge web of assets, liabilities, and risks that no one could really keep up with anymore. The balance sheet was really messed up. So when things started going bad, they started going bad for the entire financial system, and this started trickling down on all the major financial institutions. So basically, after all this, the government did have to step in, and they introduced a new policy called TARP, called the Troubled Assets Relief Program. But basically, it was a huge bank bailout. Because by the end of this crisis, all the major banks had been merged into a couple big banks that were too big to fail. Um, the government had to step in and bail these banks. And so, who was to actually blame for this entire crisis? Obviously, the government was to blame because they didn't step in soon enough, and they also actually created more laws to deregulate the market. Not to mention the SEC, who didn't step in enough, and regulating agencies who did not do their jobs correctly. But beyond that, accounting and accounting firms played a huge role in the 2008 financial crisis. Auditors were not doing their jobs correctly and found nothing wrong with the balance sheets at these big firms. Not to mention, big companies like Enron and the Lehman Brothers were investing huge amounts of money in credit default swaps.
That was just an intro to the 2008 global financial crisis. If you want to keep learning, then keep on listening to our presentation.